Hey, well, Jahangir Aziz is now joining us, Head of Emerging Markets, Economics Research and Commodities at JPMorgan. Jahangir, great to have you with us here. Thank you very much for your time. We got the... let's just start with India, not the global, flipping it upside down. The GDP numbers here, right, which came in much better than expectations. And mostly the street is up their forecasts for the full year on the back of what we've seen. That is one. Other indicators like GST collections, we are done with the fourth quarter earnings season. It's still, I would say, a mixed kind of quarter, but it is better than the third quarter. What's your assessment overall as you see things?
So I think, India falls pretty much in what we've been seeing in emerging markets generally, right? So if you look at, Brazil came out the day before India came out, and Brazil's first quarter was 8% quarter on quarter. So you are seeing this very strong and I would say underappreciated resilience in emerging markets. And this has been happening through 21 and 22. And I think that underappreciated resilience is the fact that the private sector went into this post-pandemic period relatively under-leveraged compared to the previous periods. In addition to that, there is still a lot of excess savings sitting post the pandemic with the balance sheets. Now, in the case of emerging markets, including in India, most of that excess saving is sitting with the corporates and not with the households, while in the developed market is sitting with the households as well as in the corporates. So I think there's a lot of resilience in these economies. And so, the kind of calculations people made saying that, emerging markets have raised rates 200, 300, in many cases, 1,000 basis points. That kind of rate hikes necessarily will have to get domestic demand down, and therefore we are going to see a terrible 2023. Well, that hasn't happened so far. Just as a way of comparison, in January, we expected first quarter for emerging market ex-China to be just 2% quarter on quarter, annualized rate. We are now clocking around 5.5%. So I think India falls part of that story. And, there are idiosyncratic things that you can point to. In India's case, where it's, an outsized export growth that took place. In the case of Brazil, you'll say, well, there was a massive bumper agricultural crop. And so there are all of these idiosyncratic stories. But if you step back, for the last 2 years, emerging markets have shown a remarkable resilience, particularly compared to, if you recall, what happened in 2013.
Sure. Jahangir, hi, good morning. The dollar is on track for its worst loss that we've seen in nearly a couple of months now, nearly 2 months now. And there's now increasing chatter that perhaps the Fed may skip this time's rate hike, rate hike in this policy, and perhaps move it to the next one. What's your own assessment of which way things could head? And in terms of a timeline, when are we looking at the signs of a first rate cut from global bankers?
I can tell you the last one, long time. So, just look at what's happening to the economy. This economy in the U.S. economy, right? So the U.S. economy in the first quarter clocked 1.1%. And we all said, that's a terrible number because we were all expecting 2.5%. But look at the details. You had domestic demand or final sales, ex inventories running at 3.5%. You had 2 straight months of inventories being reduced. So in this quarter, the U.S. economy's domestic demand or the final sales demand is running around that 3.5%, whereas there is very little stocks. Look at the you spoke about the PMI, ISM manufacturing PMI number. Look at the details. Inventories at an all-time low. So I think that we are getting into a point where employment demand continues to remain very strong. The JOLTS numbers was almost job openings that came out, I think, day before yesterday, was 1 million more than what was expected. The number of vacancies to job opening ratios it still remains about 1.3, 1.4, and most likely after 13 months of being surprised on the upside, most likely tomorrow's non-farm payroll number will probably repeat, the 14th month of being surprised on the upside. So I think there's a lot of strength in the U.S. economy, and consequently, the Fed most likely will pause, which is what our baseline view is. The market had expected, the Fed to actually raise, and then after the pre-meeting signals sent by both by Jay Powell as well as by Vice Chair Jefferson, the market is basically looking at a much lower probability of a rate hike in June. But I think the pause is going to last for a very long time. I'm not so sure we're talking about a skip in the sense of skipping just one meeting, but I wouldn't be surprised that the Fed remains on hold and remains on hold for a significant period of time.
That's quite interesting, Jahangir. Good morning. So from what you say, the U.S. economy doesn't seem to be in a troubled spot at all. Looking at the internals, I mean, we were looking at the headlines, but thank you for pointing out the internals as well. Let me then dial back to India and this extremely strong number that we've got on GDP that surprised. And we were looking at auto sales. I mean, most of the auto sales numbers are above estimates as well. So how do you expect, let's say, the second half of the year to play out for India? We've seen bumper FPI flows in May. Perhaps could we see more of the same in the second half as well?
So, let's step back and look at, what were the big drivers? What were the big surprises? Not the big drivers of growth, but what were the big surprises? The big surprise clearly was exports, followed by the fact that we not only had the central government capex being higher than what was budgeted, but also the state government this time around actually did some work and put in some more capital expenditure, right? So as far as the capital expenditure is concerned, if you look at the budgeted numbers, I don't think that is going to flag off. What is really concerning is that that pickup that we saw in exports of services and goods, that's where really the challenge is, because the global economy is slowing. Despite the fact that the U.S. economy is surprising on the upside, it is surprising on the upside because we do expect it to slow. It is just not slowing as much. If you look at manufacturing, you spoke about that the 7th straight month, the ISM manufacturing index slow down. Look at what's happening in Taiwan in terms of actual industrial production or the bellwethers of the manufacturing global cycle. All of them are showing that manufacturing as the driver of global growth isn't doing very much. In fact, it's doing the opposite. Now, we are expecting the fact that, final demand is so high in the U.S. and there are no inventories, that at some point in time, in the next couple of months, we are going to see a turnaround in manufacturing. But so far, the global economy is essentially is being driven by services. And that's where India is not that strongly connected to the global economy. It is to the services exports, but we know that's much more linked to specifically to the tech sector, etc. So I think that's where the concern is. The concern is that the global economy slows, and with that, export slows, and rather than 6% this quarter, moving towards 7 or 7.5, which many people in the market have. We have a view that you're probably going to see growth slowing down towards the 5 handle. In fact, for 2023, 2024, we have raised our growth forecast after the 6.1% surprise from 5 to 5.5%. But it's very hard to see that number being realized without significant support coming from the global economy.
Jahangir, just one last point. This is... you can choose to answer it or not. The U.S. index, right, has been led by just 6 stocks. I was looking at data. 6 U.S. stocks are responsible for a full 100% of the S&P's 10% gains this year. About 70-80% of the NASDAQ's gains this year. And this is all led by the AI sort of revolution, which perhaps will happen. Is it a fad which will fade, or is it here to stay?
Look, I'm the wrong person to answer that question.
I know, but what's the house view? Is it...
The house view has been that we had been negative on U.S. equity right from the beginning of the year. We did not expect this sudden burst of these 5 or 6 stocks. We are actually looking at just 5 stocks to rally the entire index. We do expect this, rally not to last very long because, as you pointed out, the 495 stocks of the 500, S&P 500 are basically skating water at this point in time. But that's the house view.
Skiing. Racing ahead, and what a rally they've seen. Who would have thought, right? The Nasdaq is up 30% this year, Jahangir, and we're not done with even half the year. It's a fantastic performance.
Absolutely. I mean, that's what technological breakthroughs and surprises do to you, right?
Absolutely. Yeah. We'll leave it there, Jahangir. It's a great chat as always.
Sure.
Thank you very much for your time. Appreciate it here on CNBC-TV18. We'll take a very quick break here. We're back. Our list of top stocks to watch for the day. Our research team will be with us to get you that in just a bit.